Hey everybody, John, Herman Property Up. Today I want to give you a little bit of information about mortgages and how they affect you. So what I'm doing is I'm taking the information that is provided by any agent that works in Property Up in the buyer's toolkit we give to each one of our buyers. And what I'm going to do is just skim through some important areas that we go through on the mortgage questions, basically, that we give you. So you can ask the mortgage broker questions and kind of push them in the corner versus them pushing you in the corner. So, all right, question number 1, and this is a good one. Are your rates and terms, fees, and closing costs negotiable? Now, if you start asking that right off the bat, you know that they are. So that is a good way to tell a mortgage broker, I know what I'm doing, and you need to give me an answer to that question. All right, question number 2 is, how long does my rate lock last for? This is a very good question to ask as you're going through the buying process, because what happens during the buying process is it may extend further than you want it to, and if it does, you may lose that interest rate you agreed upon. Some of these locks can be 30, 60, 90 days, and as long as you get a contract in place before that lock goes away and you close before that lock goes away, you won't run into additional fees, because some of those fees can be quite tremendous when you start looking at them. And one last question I have for you to ask the mortgage broker is, let me see here, which type of mortgage plan do you think would be the best for me? So that one is very good because it's really going to depend on a lot of different things. You're talking about how much interest rate you're going to be paying because of your credit score. It could be because of the amount of time you've been at your job. There's so many different things. I just want to go through the whole list. But these are good questions to start off with on your mortgage broker. So hopefully you found that helpful. And I do want to peel the onion back a little more on mortgages. So if you want to click off now, you can click off. If you want to keep listening, you can. All right, so a little deeper into mortgages. This is my face-to-face true education on mortgaging. So I am also a private lender, and I understand what it is when you're looking at money, leverage, and borrowing, and so on and so forth. So when you're looking at all these down payments on mortgages, say you're 20% conventional. Everybody seems to want to do the 20% conventional because it's the thing to do. But actually, think about it this way. If you run into an issue down the road where you have to let the house go into foreclosure or something to that effect, what happens is now you have 20% down. Say it's a $200,000 home, you put $40,000 down, that's going to be gone. But if you get into these newer conventional loans, which you're going at 5 or 10% down on a $200,000 loan, you're only looking at $10,000 or $20,000 in on a foreclosure, and then you have the money in your pocket instead of the bank having it. So it's kind of a way to protect yourself if you can look into more of the lower down payment conventionals. Yes, your payments will be higher each month, but if something big bad happens, you're going to have the money in your pocket versus the bank having it and taking it in foreclosure. So I just wanted to give you that. Hopefully you found it helpful. And if you have any more information, let's start a conversation. All right? You have a good day. We'll talk to you. Bye-bye.